Did you know that 82% of small businesses fail not because of a bad product, but because they run out of cash? That's not a sales problem, that's a finance problem. Welcome back. Today we're breaking down Entrepreneurial Finance and Accounting, the chapter most business students skip, and the exact reason most startups don't survive their third year. By the end of this video, you'll understand how to manage money like a real entrepreneur, what financial statements actually mean for your business, how to find funding, and how to keep your company alive when things get tight. Let's get into it. Section 1. Why financial literacy is non-negotiable for entrepreneurs. Here's a mindset shift you need to make right now. You can be the most creative, passionate, hardest-working founder in the world and still go completely broke. Why? Because passion doesn't pay the bills. Numbers do. Financial literacy is the ability to read, understand, and make decisions based on financial information. For entrepreneurs, this isn't optional. It's survival. Think about it this way. When you launch a business, you're not just the product person or the marketing person. You are the CFO whether you want to be or not. At least in the beginning. And even when you hire an accountant later, you still need to understand what they're telling you. Otherwise, you're flying blind with someone else holding the map. Entrepreneurs who understand their numbers can spot problems before they become disasters. They know when to spend aggressively and when to cut costs. They can have real conversations with investors without embarrassing themselves. And most importantly, they can make confident decisions instead of guessing. Financial literacy isn't about becoming an accountant. It's about knowing enough to ask the right questions and recognize when something is wrong. So what exactly should you be tracking? That's where our next section comes in. Section 2. The 3 financial statements every entrepreneur must know. There are 3 core financial statements that tell the story of your business. Think of them as a health checkup for your company. Each one measures something different. First up is the income statement. This is also called the profit and loss statement, or P&L. It shows you how much money came in, how much went out, and whether you made a profit or took a loss over a specific time period, usually a month, quarter, or year. Revenue minus expenses equals net income. Simple in theory, but incredibly powerful in practice. Second is the balance sheet. This gives you a snapshot of your company's financial position at a single point in time. It lists your assets, everything you own, your liabilities, everything you owe, and your equity, what's left over for the owners. The fundamental equation is assets equal liabilities plus equity. If that equation doesn't balance, something is wrong. Third is the cash flow statement. This one is arguably the most important for early-stage entrepreneurs. It tracks the actual movement of cash in and out of your business. Here's a surprising truth. A business can be profitable on paper and still go bankrupt. How? If customers owe you money but haven't paid yet, your income statement looks great, but your bank account is empty. That's called a cash flow crisis, and it kills businesses every single day. Understanding these 3 documents together gives you the full picture. One shows profitability, one shows stability, one shows survival. But even with strong financials, every business eventually needs more money to grow. So where does that money come from? Section 3. Funding options for entrepreneurs. Let's talk about money, specifically how entrepreneurs actually get it. There are several main funding sources, and choosing the right one depends on your stage, your goals, and how much control you're willing to give up. Bootstrapping means funding your business with your own savings and the revenue you generate. It keeps you in full control and forces financial discipline. The downside? Growth can be slow when you're limited to what's in your own pocket. Friends and family funding is often the first outside capital entrepreneurs access. It's informal and fast, but it comes with personal risk. Mixing money and relationships can get messy quickly, so always put agreements in writing. Bank loans and SBA loans are traditional debt financing. You borrow money and pay it back with interest. The upside is you keep full ownership. The downside is you need good credit, collateral, and a solid business plan to qualify. Angel investors are wealthy individuals who invest their own money into early-stage startups. They often bring mentorship and connections alongside the capital. In exchange, they typically take an equity stake, meaning they own a piece of your company. Venture capital, or VC, is for businesses with massive growth potential. VC firms invest large amounts, but expect significant equity and a say in how you run things. This route isn't right for most businesses, but for the ones it fits, it can be rocket fuel. Finally, crowdfunding platforms like Kickstarter or Indiegogo allow you to raise small amounts from a large number of people. It's also a great way to validate your idea before you fully launch. Each option has trade-offs. The key question is always, what does this money cost me? In interest, in equity, or in control? Understanding your options brings up a deeper question. How do you know if your business is actually performing well? That's where financial ratios come in. Section 4. Using financial ratios to measure business health. Ratios are like vital signs for your business. You don't need a medical degree to know that a heart rate of 200 is dangerous. And you don't need to be a CPA to know when your business numbers are in the danger zone. Let's look at a few key ratios every entrepreneur should track. The current ratio compares your current assets to your current liabilities. It tells you whether you can pay your short-term debts. A ratio below 1 is a red flag. It means you owe more than you have readily available. The gross profit margin shows what percentage of revenue remains after covering the direct costs of producing your product or service. A shrinking margin over time usually means your costs are rising faster than your prices, which is a serious problem. The debt-to-equity ratio measures how much of your business is financed by debt versus owner investment. A very high ratio means you're heavily leveraged, which increases financial risk. Tracking these ratios over time reveals trends. Are things getting better or worse? Are you moving toward sustainability or toward a cliff? Ratios give you early warning signals, so you can adjust before a small problem becomes a fatal one. But knowing the numbers is only half the battle. Managing your cash day-to-day is where businesses actually live or die. Section 5. Cash flow management, the lifeline of your business. We keep coming back to cash flow because it is that important. Profit is an opinion. Cash is a fact. Cash flow management means actively planning when money comes in and when money goes out, and making sure you never hit zero in between. A cash flow forecast is a simple projection of your expected cash inflows and outflows over the next weeks or months. It helps you anticipate shortfalls before they happen so you can act, whether that means collecting receivables faster, delaying a purchase, or securing a short-term line of credit. One major cash flow killer is slow-paying customers. Setting clear payment terms up front, sending invoices immediately, and following up on late payments are habits that protect your cash position. Another strategy is separating your business and personal finances from day one. This makes tracking easier, protects you legally, and helps you see clearly what the business actually earns and spends. Finally, every entrepreneur should aim to build a cash reserve, a financial cushion for slow months, unexpected expenses, or market downturns. Even 1 to 3 months of operating expenses in reserve can be the difference between surviving a tough quarter and closing your doors. Outro and CTA. Let's wrap it up. Financial literacy isn't glamorous. It doesn't go viral on social media. But it is absolutely the foundation of every business that survives and scales. You learned why financial literacy matters, how to read the 3 core financial statements, where entrepreneurs find funding, how to use ratios to monitor health, and how cash flow management keeps everything alive. If this video helped you, hit that like button. It genuinely helps this channel grow. Subscribe so you don't miss the next chapter breakdown. And drop a comment below with one question you still have about entrepreneurial finance. I read every single one. See you in the next video.